Welcome to the Investor Fuel Real Estate Investing Show, where I interview the nation's top real estate entrepreneurs, industry leaders, and other amazing entrepreneurs to help educate and inspire you to take your business and your life to the next level. My goal is to add tremendous value to you during every single episode of this show. If you get value, I'd love it if you subscribe on your favorite podcast player, subscribe on YouTube, and my very favorite, please share this with your community so we can impact even more entrepreneurs. Let's start today's show. Hey, everybody. Welcome back to the show today. I'm here with my good friend, Eddie Speed. We've been friends for a long time here in the Dallas market. I guess doesn't really matter where we live, but we're friends. And we're going to be talking about why you should consider selling your rental properties and owner financing them in probably a unique way that you've never heard before. So, Eddie, welcome to the show.
How are you?
Yeah, good to see you, buddy. Always good to hang out with you.
Yes, sir.
Yeah. So obviously a lot of folks know who you are, but maybe just share a little bit about your background for those that somehow don't know who the one and only Eddie Speed is yet.
Well, I'm a specialist. I started in 1980 buying seller finance notes. My wife and I married in 1982. We moved from Mississippi, where the guys that mentored me and got me started, and we moved here to Dallas-Fort Worth to buy notes. Back then, you kind of needed to move to the market. And anyway, that's turned out great for us, and we've been here I now have about 4.5 decades of buying notes, and it's been many turns along the way and been quite a ride.
Yeah, yeah. And there's a lot of folks that owner finance. I have some owner finance notes, just some rentals I sold off and kept the notes. Yeah. But you really do way more than the kind of simple owner financing. So just tell us a little bit more about kind of what your area of expertise is.
Well, I'll go back a little bit. So in the 80s, I was buying notes from generally just individuals that bought notes, but I started buying more and more from real estate investors that created notes over and over. And there was a couple of brothers here in Dallas-Fort Worth that did that, and their last name was D'Angelo, right? And so then Ken came along, and he wanted to start Homevestors, and he came to me and says, look, I'm doing a franchise. My franchisees have to know how to make a hamburger, right? Every hamburger needs to be the same hamburger. And so that launched me into a whole idea that the industry had never done, which is basically take a real estate investor and build him a mortgage banking platform, a definition for terms of the sale, terms of the loan, terms of the underwriting, just like a mortgage bank. And we killed it. I mean, we really did really well doing it. And then that launched me into the fact that I started doing it for a lot of other real estate investors. Mm-hmm. And that's kind of, people say, how in the world have you bought 50,000 notes? Like nobody else in the note business has come close to that, buying seller carry, right? Yeah. And the answer is pretty simple. I did it because I built a note manufacturing system that they could then sell their notes and not take a big, discount in what they sold the notes for.
Yeah. Yeah. So a lot of us as real estate investors, like we historically have aspired to build wealth through rental properties, like keep rentals. And, I have a rental portfolio as well. And so, we look at it for a lot of reasons. It's like, hey, I'm going to generate some cash flow, which they've never really cash flowed as well as I had hoped. Yeah. The appreciation's been real, but there's also been destruction of the dollar at the same time, right? And so we usually look at it as like, I was just talking to some folks in Investor Fuel yesterday, and long story short, we were talking about how, it's kind of hard to sell your real estate investing business. Like you're usually you might have a team, but you're the guy, you're the man or the woman that's running the show, right? And so they're like, well, they were talking about starting another business that might be able to get a multiple of and sell at some point. And I was like, look, the real kind of wealth in your business is rentals, what you kind of keep. But I didn't really talk about notes because that's not my area of expertise. But, I guess a lot of us are trying to find ways, like we kind of make the today money through wholesaling and fix and flipping, and we want to build wealth at the same time. Yep. And so kind of, tell us a little bit about like how that makes more sense with notes than it does with rentals.
Well, first of all, it's market timing. I would never have told anybody if you start acquiring rentals in Dallas-Fort Worth in 2013 that you picked a bad time to buy rentals. Right. Property was on sale. It was you could buy it at 40% discount. Yeah. But the rents weren't on sale. Rents were good compared to values. And so as we've progressed and values have risen, rents haven't risen at the rate of values. And of course, during the virus, they certainly didn't. So if your property doubled in value, your rents didn't double, right? Your expenses far exceeded your rent raise.
Yeah.
So if rents went up, they went up and kind of settled back down. It's what seems to be the market condition overall. It's what people are telling me. So rents went up, say, by 20%. But expenses went up by the same time frame, expenses went up by 50%. Well, if that math is true, and that's a lot of fractional CFOs and people like that are telling me that, well, that means that expenses are 2.5 times greater than the rent rise. And so the problem is, let's take your current house today. So I'm just going to pick on a house in Dallas-Fort Worth that I kind of know the math of, because it's kind of an example that a real example, but it's something I've used enough. And I bet it looks like just like one of your rentals. It's now worth $250,000, but it rents for $1,800 a month. You're probably netting half of the rent, so you're netting $900 a month. So take $900 for that house, and that's a little over $10,000 a year, and divide that out, and guess what? You're earning a 4 cap. The question is do you think at a 4 cap on your $250,000 house that's underperforming? If you do, then you have to look at, like, what are my alternatives?
Right. Yeah, the biggest saving grace that we have is we've never really refinanced our portfolio. Now, do I wish I'd refinanced it at 3.5–4%? Like, yeah, but I didn't. So we have a ton of equity, but it's trapped, So I kind of look at, I'm wealthy on paper, right? But it's trapped, right? Right now it is, until I do something, refinance or sell them off, or maybe owner finance them.
I hear there's a story that it's hard to eat those equity sandwiches.
Yeah. You can't put that in the bank.
The issue is you're a math guy. Your wife's a math lady, right? I know you guys. Like, you're smart. And if you look at your net worth and you think, is my net worth earning? The answer is, if you think a 4 cap is under earning, then you say, okay, what are my alternatives? Right?
Yeah.
I'm just simply saying, take the same $250,000 house and look at a model where you sell or finance it. You sell it for $250,000. You get, and I'm just rounding numbers here. So if you got a calculator in your hand, just know I'm doing it off the top of my head, right? You sell it for $250,000. I believe that you can get 15% down. There's every market data in the world that represents to us. If you believe you can get 15% down, that's a fair market condition, right? The average down payment for a Fannie Freddie loan today, the average down payment in conventional lending is 19% down.
Okay.
See, so that's,
yeah.
And then you're creating what we call a non-QM loan, meaning they're not Fannie Freddie standards, but 40% of the mortgage market, a loan origination market, 40% of that market are non-QM loans.
Wow.
Okay?
Yeah.
So you're going to write that.
And by the way, these are people that can't qualify for a traditional mortgage, and it's not necessarily because they have bad credit. They just might have no credit. They might just be.
Let's just talk about the competition. If you're the bank, who's your competition? Fannie and Freddie, FHA.
Yeah.
Right? Okay, well, let's talk about that. Mortgage Bankers generates a chart called the Mortgage Credit Availability Index. Since the virus started, the day the virus started, it was at 185. Today, it is at 95. So basically, 50% of the people that could get a mortgage before the virus through a conventional mortgage can't get one today. So you're saying, I have a huge opportunity to fill an underserved market, and I'm not chasing the guy that's unstable. I'm chasing somebody that's super stable. I'm just giving them a chance for home ownership. So this triggered with me a couple of years ago, this whole idea of why would you sell or finance your rental portfolio. So a pretty well-known guy, John Burns, they came out with an article, a couple of years ago. And they said, your people's mortgage payment on the identical same starter home that they're renting, their mortgage payment is $1,000 more than their rent. Now, Bigger Pockets and other people, like a lot of people have now written about it. But see, when most people see that, they didn't see what I saw. When I saw that article, I said, well, wait a minute, that's time for me to be the bank. Because it looks like the bank's making a lot more money than the landlord.
Yeah.
Right?
Yeah.
And so I modeled that math. And I'm like, sure enough, he's right. If I owner financed it, I'm making way more money than the landlord. But the market wasn't ready for that yet.
Mm-hmm.
In other words, people weren't willing to consider that then because we'd just been through an era where we had this crazy lift in values, and everybody's like, oh, we're just going to sweat our way through rentals and stuff. But you've had rentals a long time, Mike.
Yeah.
You saw a big surge in the market after the virus, but that wasn't necessarily consistent with what happened over the life of your portfolio.
That's true.
Right?
Yep.
So now you're looking at your portfolio and going saying, is my equity, is my asset value not meeting a annual income standard that I think is acceptable for what my portfolio should produce?
Mm-hmm.
So here's the question. What if I said you could take this same house and instead of making a 4 cap, you could make an 11 cap?
Yeah. Sounds good to me.
So that's what the math turns out to be. And then all of a sudden, then comes the big question. Okay, yeah, but Eddie, I have an underlying debt. Yeah, but Eddie, I have this. Yeah, but Eddie, I have, then all of a sudden you start realizing what I've done for my career, which is I help real estate investors recapitalize with their note portfolio. And you don't have to go sell your whole note at some giant discount. There's other ways to do it. What if I said, Mike, sell that house, create a note, and what if you guys decide, hey, we're going to keep, I don't know, let's keep 30% of the income off that note. If the note's $2,000 payment, let's go keep $600 a month. Then I have, if you create the note to the formula, if you follow the yellow brick road that we try to help you do, then all of a sudden you could keep $600 a month and go sell 70% of the payment. But wait a minute, Mike. If you sold 70% of the payment, you likely can get even more than 70% of the amount of the note. You might get 75% of the amount of the note, but keep 30% of the payment.
Yeah. I think there's a lot of people as real estate investors, they think they're either in or out. And so I've always been intrigued by you talking about partials, selling partial streams and things like that, but I don't think the average real estate investor, the average person listening to this right now, this is probably new.
It is.
Yeah, but this is not new in the mortgage banking world.
I've done 25,000 partials.
Yeah.
I mean, so for me, it's pretty regular, right?
Yeah.
But once again, this is where I found out a long time ago that I serve the real estate investor market, right? I consider you to be a specialist, right? You have this incredible mastermind. You have these marketing systems, these mail systems, these things that you have perfected. Like, I consider you to be very top of your game at helping real estate investors with what they need because you understand what they need. Well, I understand a decent amount about real estate investing, but I understand a lot about offering financing.
Mm-hmm. Yep. Yep. So let's talk about, how seller financing is the solution. If you're somebody with a rental portfolio right now that feels like taxes have gone up, insurance has gone up, your rents haven't gone up, maybe they're down in some markets. I don't think our rents are down here, but they haven't been rising for sure, right? I mean, they did, but they're not now, really.
Yeah.
And I think we're starting to feel stuff like somebody else is managing mine, so I'm not as involved in the day-to-day, but I'm sure we're having a little more turnover, a little more drama going on, which kind of happens in a down market, right?
Yeah.
And if you're a guy like me, you and I have been talking specifically about my situation, but for folks that are listening, they're like, you know what? Maybe there's another thing I can do with this, because in their mind, they're either going to sell them off, they could owner finance them and stay the bank, but they have all that equity, all that capital is still stuck for a long period of time. You're going to get a stream over time.
Right.
But not many people are thinking of selling out a partial stream of that and keeping a part of it. I don't think anybody knows that's a thing. So let's just talk about this as a solution for people that have a portfolio that might want to sell.
Well, the first thing I would say is, just my observation, people do a lot better job qualifying their tenants than they do seller finance buyers. I mean, I've bought a lot of notes, I see them every day. I don't find that people like really look at it like I'm really running a mortgage operation.
Yeah.
And so I think we can help them with that. Like I've got vendors in place that can help them with, processes so that if you don't have a back office built to do it, there's some disciplines around it so that you end up, whether you sell the paper or you keep the paper, right? We have better stats on performance characteristics of seller financing than I would say virtually anybody in the industry, right? So we're not trying to make it difficult. We're just trying to make sure that when you create paper, those payments are sticky. You're going to get the money, not wake up in a couple of years and figure out, oh my gosh, I wish I wouldn't have sold to him, right?
Yeah.
Or that,
Yeah,
right?
yeah.
Or they can't afford it.
Right.
Now you created stress for both of you. Your buyer can't afford it. Now you're having to go deal with a legal problem of repossessing.
Right.
Right. So that you're trying to avoid that. And so I would say that's the template that we're trying to do. And 25 years ago, I've been doing the whole industry for 45 years. 25 years ago, what I figured out was this, Mike. People don't know what they don't know. And I built a school. I'm a legitimate note buyer that's very active in the market. Like I'm not a guru teaching something I have limited experience with, right?
Sure.
I'm
Yeah.
still deeply involved in the space. But the school teaches people the principles that all of a sudden, like now they know how to do it. And now, like you said, partials. Like, what is that? Like, and when people, every time people say that, or people come down the road with us a little bit. We were talking about you guys, like even coming to a class, right?
Mm-hmm.
They're going.
And I've been once before, but
you have.
Yeah,
you have.
It's been a while.
But people walk out of there going like, I had no idea. Like
Yeah.
that's the common answer from super seasoned real estate investors to beginner real estate investors. I had no idea. And so we just found out we're just uniquely specialized knowledge, and we're just sharing something with them that's common to us. And now all of a sudden when they see it, it starts showing them you can be just as creative with your financing as you can be with other aspects of your business.
Right. Yep. One of the things that people push back on, I think, is, and I've been guilty of this, of saying the appreciation, I'm worried about losing out on appreciation. That's one of the things with my notes. I mean, I'm trading at a high level. I'm trading off. I don't have to do maintenance stuff. I'm not doing make-readies. I don't pay a property manager.
Yeah.
But I'm like, but I get the appreciation,
Yep.
right? But, again, I am a recovering finance guy, right? But at the same time, if I think about it, it's like, well, what has inflation been like? I mean, there's a margin there. It's not like just because my property's gone up 100% in value or 400% in value in some cases, the dollar's worth less today than it was when I bought them 12 years ago, right?
It is.
Yeah. So what are talk about the kind of typical objections to why somebody should sell a rental, and maybe
So one of the things that when
thoughts?
somebody comes down the road and they want to go to our note school, right? One thing I like to do is like we're fairly good at math, and we're fairly good at actually just using math tools. And you know what I'm saying, right? Like I'm not making up numbers. I'm plugging it in the calculator or in Excel and saying, tell me the number.
Right.
So let me give you some easy math, okay? I'm owed $1,000. Today, I'm holding $1,000, so I have the $1,000, and I'm saying, what's the present value of that money today? Well, I'm holding it in my hand. It's worth 100 cents on the dollar.
Mm-hmm.
But wait a minute, Mike. Let's say that you promised to give me $1,000 5 years from now, right? And I know you, and you're good for it. So I know I'm going to get the money, so I don't have to build in a risk variable, just a time value of money variable.
Right.
Okay? So I'm going to get paid. It's just when am I going to get paid? And so in this scenario, you're going to pay me 5 years from now, and I plug it in Excel at an 8% yield. It tells me it's worth 60 cents on the dollar. But wait a minute. You're not going to pay me in 5 years. You're going to pay me in 10 years. Now the money is 10 years away from me. Same $1,000, just due further in the future. I ask Excel, present value of future dollars, it's worth 38 cents on the dollar today. That's just math.
Right.
So the answer is if you can get money now, more money now, it will always outpace what you think it's going to do in the future. And I will
sure.
challenge that I can take anybody's rental portfolio. Somebody could have perfect market timing. Okay, they bought a property in 2021 and the market lost their minds, and now all of a sudden that can happen, but is that going to happen in the next 5 years? Is the same market appreciation, is that hockey stick going to be at the same rate in the next 5 years that it was today?
Yeah.
And so if you think not, then all of a sudden you start realizing analyzing when I get the money is just as important as am I going to get some money?
Mm-hmm. Yeah. And so one of the things when you own a lot of people, me included, like all my owner finance notes, which I don't have a ton of, but I have some, is I just made up stuff that kind of made sense, right? I know that's one of the biggest things that you argue against is standardizing the paper so you can resell it.
Yes.
So when you sell it to an institutional buyer, they don't want to have to analyze every note. If it doesn't fit these guardrails, then we're not interested, right?
That's right.
Talk a little bit about that, because I think most people are just like, I'm going to try to get the highest interest rate I can. I'm going to try to get some money down. In fact, I was trying to not get a lot of money down because I knew it would be worth more if I wrapped it into the note, and I was just willing to take that risk. But talk about how the mortgage banks look at it if they're going to be your buyer.
Yeah, so you've got minimum standards for an underwriting box. You have minimum standards credit, minimum standards in down payment, minimum standards in the debt-to-income ratio. By the way, these institutional investors are not crazy. They already own hundreds of millions of dollars worth of these assets.
Right.
They know what performs and what doesn't perform. I know what performs and doesn't perform. And so we're just saying it'd be like me going to you and Mike saying, Mike, what's your underwriting standards for qualifying a tenant? And I'll bet you $1,000 you and Lindsay can tell me exactly, like, we've done this, but we found these are minimum standards, right? You've defined that for your rental business. I'm just helping you define it for your seller finance business.
Right.
And now all of a sudden you can go sell the loans at a far lower yield, which is more money to you. The lower the yield you sell the loan at, the more money it brings back to you. And that's because you've created loans that are homogenous. Like for our friends in other states, like they're all going to brag and say, yeah, Eddie, I seller finance, I write it on a land contract. Well, let me just tell you something. You just annihilated the institutional market. Like they're going to pay at least 10% less.
Really?
Yes. Don't look. Homemade is not good. Homogeneous is good.
Yeah.
Like homemade does not fit the institutional world. Look at commercial real estate. Look at multifamily. There's properties that fit the corporate buyer, and there's properties that fit the mom and pop buyer, right?
Yeah.
It's true in every asset class. So I'm helping you create paper that fits the institutional world.
Yeah, because that's where you're going to sell it.
For the most money.
Yeah.
I bought 10,000 land contracts in the last 10 years. It's not like I don't know how to buy land contracts. They're just not, I just don't pay as much money for them.
Yeah. Yeah. So talk about underlying debt. So sometimes people have bank debt. They might have a sub-2 that they want to, how do you handle those situations?
That's where selling part of the payment comes in. Is now you're recapitalizing. If you sell the property and get 15% down, and then you can go get hypothetically 70% of your loan balance. Wait a minute, that's 85% of what the property sold for. Mm-hmm. And that gives you, so some people don't have enough equity to make the math work, but we've built some modeling that's fairly easy to do. One of the things that I'm going to have a little deal where people can get this little class, and one of the things I'm going to give them is coming to the class is I'm going to give them a little spreadsheet, and with that little spreadsheet they can just, it's what I told you. You can just enter your property information, literally about 4 columns, and it bills out all a note model potential.
Yeah, yeah. So maybe talk about the long-term value of do you have to, because these notes could get refied, right? That's one of the other risks is, you could model it out and say, hey, over 30 years I'm going to make X, but some of these refi out, especially with interest rates as high as they are. I mean, it used to be when I was owner financing my houses, they were usually around 10%, but the market was 5%,
Yep.
And so now that spread isn't as big. And so just talk about the need in this model to continually do deals maybe because you got to keep feeding the machine,
I think that's always going to be true.
Yeah.
I mean, you're getting a lot more cash flow, so you're getting a lot more. But once again, then all of a sudden, but it's like you and I were talking about personally. Like, wait a minute, what if you and Lindsay considered buying notes? Like buying long-term notes, not even just doing hard money loans, but what if you considered like buying notes as an alternative to buying the next rent house? I guarantee you're going to like the math because the cash flow is probably a 3x. If the rent house netted you $1,000, you can take that same capital and buy an existing note, and you're probably going to be close to $3,000 on the same dollar.
Wow.
So so understand that's why I built a school, is to say, what do we see that's common to us, but a real estate investor very, very much understands buying property. They understand the collateral. They understand repairs. They understand all of that. So we're saying they're already kind of 80% there because they already understand concepts. We're just kind of adding to things that aren't so common to them.
Yeah. And one thing that we haven't talked about yet that people kind of forget about is if you sell your rentals now, like if I sold my rentals now, I'd get hammered with a tax bill. I either have to 1031 them, or if you own or finance them, though, talk a little bit about
You
basically
stretch it out.
You stretch it out over a long period of time, right?
Right. And there's two things you can stretch out. You can stretch out your gain, and you can also stretch out your long-form depreciation. So if your recapture,
Right.
right? So
because ours are fully depreciated at this point. Yeah.
But once again, your long-form depreciation has an installment sale strategy somewhat like your gain, and so there is a tax hack to it.
Yeah.
There's more tax hacks even. There's even stuff I can show you about that people like just never thought about. Like that, it's a little deep to get into in this interview, but just to say, just think in terms of most of my clients are professional real estate investors. Most of my clients are you, Mike.
Mm-hmm.
They have a portfolio and they're buying properties. They can do the same thing on a brand new acquisition they can on existing rentals. They can create notes and create income strategies. And then all of a sudden I've been asked 1,000,000 times, well, what about this and what about that and stuff? And so we've stumbled into, I think, some pretty good tax hacks that like just people generally haven't thought about.
Yeah. Yeah. So if folks are thinking like, I'm intrigued by this, I want to consider maybe turning my rentals into notes, or maybe with new acquisitions, even turning those into notes so that they can, because the truth is, like, let me ask you this. If we walk through an example of somebody that would buy and fix and flip a house, let's just hypothetically, just to keep the math simple, say it's a $100,000 house, which isn't realistic in many places anymore, maybe no place. But let's just say an ARV, the market value of a house is $100,000, just to keep the math simple. Sure. So if they were going to, say they buy that for $50,000 and they put $20,000 into it, and they've got 30% of kind of equity, but they're going to have some closing costs and transaction costs there, and they sell it for $100,000 on the MLS, and maybe they net 20 ish. So walk through that scenario of, instead of selling it the traditional retail way, how you could sell that
and sell the note
and keep a partial of that. This, because I really want to cement this home.
I think this is what I generally believe the math will prove to be true. You can take a brand new deal that you have some equity in, either because you bought the equity or you put some capital into it. Whatever you could do with a Burr model, you can kill it with a note strategy instead. And I was at an event that you and I were at the other day. Like, these are all a pretty high level bunch of people and stuff. And I basically said, in most cases, this will crush a Burr model. And somebody goes like, what? But you got to remember, I've been modeling this for 2 years.
Right.
Right? And so I've seen enough examples. I just kind of know what the math is.
Yeah.
If you have equity, whether you inserted the equity by cash or you bought the equity and buying it at a deeper discount, then that model, that cash flow model, you're going to like a note better than a Burr.
Yeah. In this example of selling it for $100,000, though, the mortgage banks would maybe buy this from you for 75%, which, by the way, you only have 70% in it. So you could potentially make money on a sale. You might defer some of those gains, but then now you've got a piece of the mortgage, maybe 25 or 30%, that you keep on an ongoing basis. But you don't own the house; you're just getting a stream of payments for as long as that mortgage exists.
Yeah, I mean, if you did the Burr model on the same property, you're going to have debt service, and how much are you netting after you have debt service on a rent house today?
Yeah.
it's not going to be great math, right?
Right.
So understand, what if you could keep 30% of the payment? You sold it for 100, you financed, you got 15% down, so you only financed 85,000. You took 15,000 off the table, right? Because you got it in a down payment.
Right.
So then all of a sudden you're saying, okay, I got an $85,000 note, and it's throwing off, just make up a wild number, it's throwing off $850 a month, right? Then all of a sudden, boom, I could keep 30% of that payment, and I already got all my money back plus profit.
Right.
So it'll help when people come and we can whiteboard it. It's a little bit difficult, just kind of describe it with your hands, kind of thing.
Yeah.
But you get the point.
Yep.
Is like I know how savvy you are, and I know even when I sat down today before we even started the conversation, you're like, wait a minute, you've been kind of saying this to me, but I wasn't really following the math as much as you're explaining it today.
Mm-hmm.
And that's the conversation I'm having over and over and over. A lot of your great clients, a lot of your great sponsors in your group have really spun their head around to this because they've realized the market's probably not changing. Maybe should I change how I'm looking at my assets?
Yeah. Yep. So if folks wanted to get started with this, how do they do it? Like, how do they move forward here? I mean, there's an educational piece of this that a lot of people don't have yet.
Yeah. So the easiest way, I think, is we have a little master class. It's virtual. It's a couple of hours. I do it with Max Keller, who you know very well, and we just beat it up. Like we put real examples up there and real scenarios, and we show people. And it's showing them two dimensions of the business, maybe the rental model or maybe just a note model. And you start realizing that if you're selling your rental and creating a note, you are now in the note business. So you need to have some understanding of what that means. And, it's something that we'll do and give your guys. I mean, I'm not charging them. And if they decide they want to like it and go learn more, I'm cool with that. Yeah. But if that was enough and it helps them kind of maybe realize it's not a fit for them, or maybe it's possibly a fit for them, then all of a sudden they know more than they did.
Yeah, that's awesome. So if folks want to learn more, Eddie, about this, like, where can they go to learn more?
So we built a link for your team. So it's going to be noteschool.com/investor fuel. And that'll take them to a registration page for a couple of hour class.
Cool. I'm going to take this class myself, or I'm at least going to get my wife to do it. So
awesome.
Try to. I have to ask. I can't tell her to do it.
I get it.
You know how that works.
Yes.
Yeah. Well, hey, thanks for spending some time with us today.
Thank you.
Yeah. Appreciate you always, buddy. Guys, there's a lot of ways to make money in real estate, and this is intriguing to me. We have a rental portfolio that has done very well, but we're a lot of that wealth is on paper. So I'd love to see more of that cash flow coming in. So I hope you got some good value from today. Make sure you check out Eddie's on-school masterclass. Noteschool.com/investorfuel is the link. We'll add it down below in the show notes. So appreciate you guys a bunch. We'll see you on the next show. Thanks for joining us for today's show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing on your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. You can also check out the show's notes for access to free resources, how to get access to world-class lead generation, and even how to work with me directly one-on-one. Don't forget to subscribe so you never miss another episode. See you on the next show.